How bad and long will this real estate crash be? Now, over the last 2 years, I've made several videos on the housing market. Everyone's been expecting a massive crash in housing prices since 2020 when the entire economy was shut down. But while everyone was waiting for house prices to go down, they continued going up. And not just a little bit. Home prices shot up higher and faster than any time in history. And while many think the big crash will finally come, depending on what data you're looking at, it might already be here, and worse than the great financial crash of 2008. So in this video, I'm gonna break down the different types of data so you can understand why you hear and see conflicting reports. I'm gonna show you the data and charts to explain why this is happening. I'm gonna show you the best areas of the country and the worst, because there's a massive difference. And then we're gonna look at the 3 factors that determine where real estate prices go from here. If you own a home or want to buy or sell a home next year, then you need to watch this. So let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss, and I make these videos to change the way you think about money, because almost everything you've learned is wrong, and it's complicated, and they lie to you. Now, just a heads up, a lot of doom and gloom in this video. However, there's a lot to be hopeful for, a lot to think about for next year, and hopefully you'll start to take this time to start to think about where you want to be next year. We're going to navigate this correctly, and even though the markets, the economy looks scary, there's hope for us. We're going to survive. We're all going to be okay, as long as you keep watching this channel. All right, now let's talk about this, home prices. And we've talked about, are home prices going to crash? I asked on Twitter, which, by the way, if you don't follow me on Twitter, you should, @1markmoss. And I said, what is a home price crash? Is it a 5% correction, a 10% correction, a 30% correction? Well, let's take a look and see what we got going on. It is no longer a debate. It's here. Home prices are going down, all right? No matter where you're at, no matter what type of home you're looking at, home prices are going down. But the question is, how? How much? And where are they going down? Now, I've said over and over and over, I make real estate videos quite frequently because in my early career, I was a full-time real estate investor. I fixed and flipped hundreds of homes, built ground up. As a matter of fact, I built this building that we're recording from now. I'm not a full-time investor anymore. However, I still am a real estate investor, so I still pay attention. And the one thing I remind you of over and over is there's no such thing as the real estate market. There's thousands of real estate markets broken down by size, type, price, location, all those things. So we're gonna look at that. So how much and where are prices moving? So what I can tell you is that nationally, home prices are down about 2.2%. All right, we can see that in a chart right here. I have a good chart pack here from Eric over at EPB Research. I got a lot of charts from his article that he put out. I'm going to link to it down below. So shout out to Eric from EPB Research. So we can see right here, Case-Shiller. We can see where prices plunged right here from the pandemic. But right here, we can see prices are dropping about 2.2%. That's nationally. So that's what you consider the real estate market. However, of course, if we dig into it, we can see it's a lot more granular. So for example, in Miami, home prices haven't really moved at all. As a matter of fact, they're down less than 1%. So they're basically flat. Home prices really haven't done anything there. Seasonality, if you adjust for that, we're really not down anywhere. However, if you go over to Seattle, for example, we're down almost 10%. 10% in Seattle, 10% in San Francisco. But one thing that I always like to draw your attention to, which is why I use charts, and we'll go to some more later, is the move, the size, but also the speed of that move. That's very important. So we'll come back to that in a minute. But what we can see is that they're moving nationally 2%, less than 1% Miami, Seattle, San Francisco, 10%. That's a really, really big move. Like I said, I like to show you the charts and the graphs because I want you to see the rates of change, not just the move, but how fast it's moving. Now, what we can see when we look at the data is that major cities were rising between 20 to 30% going up. Home prices have been going up like crazy for the last couple of years, or really for the last decade, ever since they bottomed somewhere around 2012. They've been going up, but of course the last couple of years, with all the stimulus money, they shot up like a rocket ship. We can see Dallas, San Diego, Seattle, San Francisco, Tampa, Florida, we're all up over 40% in just like 2 years, a 40% increase, which is astronomical. And I'm going to show you why. We'll look at the data. But now we can see that a lot of these cities are seeing the same or the worst size declines. Now, if we break this down, we can see home appreciation in major U.S. cities. Now, remember, there's no such thing as the market. There's thousands of markets. We can look at the U.S. Major cities, but a lot of what's happening is in the rural areas. We're going to dig into that in a minute. But what we can see right here, here's the zero line right here. And so we have here Atlanta, Boston, Cleveland, Chicago, Charlotte, Las Vegas, all the way down here to Washington, D.C. And you can see how much they increased here. And now you can see this city, so here, for example, Atlanta, which had this massive increase, is now starting to decline just a little bit, right? Or some of these areas right here, like Miami, right here, with big increases, barely going down as well. So you can start to see that in the data. A better way to visualize this, if we look at a 3-month average, remember we have to adjust for seasonality, so we like to look at a little bit of averages. What we can see right here is this is pre-COVID, so this is March of 2020 up to 2022, and we can see the 3-month average, all these cities were going up, and now we can look at this 3-month average from September, and we can see all these cities are going down. And for an even better chart that really highlights or exemplifies the rate of change, here's the Case-Shiller National, and again, so this is nationally, but look at this rate of change. So here we have going into the 2020 pandemic, and then the markets started shooting back up higher. This goes all the way back to 1995. This is 2008, sorry, 2008. We can see it crashed right here. The prices went all the way back up. But over this time period, even in 2008, how bad that was, but look at the path that went down, like a 45-degree angle. Here, look at the path that it went down. Straight. That's like a that's straight downhill, and we can see that rate of change. And so it's already worse than 2008. It's already. Now in some cities, now in Miami, it hasn't gone down at all. We're going to keep digging into that, don't worry. So it's down 8.5% in 3 months. So remember, we're looking at the rate of change in 3 months. If we extrapolate this out, it's going to be way worse than 2008. And so that is what crashing looks like, back to that poll that I asked. However, not everybody's seeing it. San Francisco, Seattle are seeing a crash worse than 2008, but Miami, what crash? What crash are they seeing? Now, we can see that the pandemic stimulus rose all markets. But the declining values are not even. So it depends on where you live, what house you want to buy, sell, and how it's going to affect you. What we can see here is another good chart from Eric, is we can see the change in median home prices April pre-COVID. And so what we can see here is all these blue dots are where home prices were going up like crazy. The West Coast, big time in Florida, this whole southeast area, of course, Texas right here. And now, if we look at it now, we see the change in home prices post-COVID, and we can see similar thing, same thing. Of course, the West Coast that went up big time is now declining big time. Florida, as much as it went up, it held pretty good. Same here through the Southeast and Texas, and so it's holding up pretty good. So you can see that just because it went up so much doesn't necessarily mean it's coming back down. So you can see that it's very sporadic. Most of this area is not even affected. Crash? What crash? If you live in San Francisco, it's a bloody market, all right? So you have to understand that there's no such thing as the market. Now we can see some other data here. I like to give it to you a couple different ways so you can visualize it. Here's home prices decline from the peak. So here we have Cleveland, Chicago, Atlanta, barely seen. I mean, this is all less than 1% right here. Less than 1%. And over here we have San Francisco, Seattle, San Diego, Los Angeles, Phoenix, Denver. All these chart packs, I want to have a link to them down below so you can download these, you can digest them, and you can find out where your city ranks on this. So check it out in the comments down below. Now, I also like this chart right here because it shows you kind of a color code. This is done by county. And so you can see all of these counties that went up and then all these counties that are going down. But again, it's not the entire country. There's no such thing as the market. Instead, like I said, thousands of markets. The worst cities so far are San Francisco, Seattle, San Diego, Los Angeles, Phoenix, and Denver. Those are the worst cities in the country. The best so far are Cleveland, Chicago, Atlanta, Miami, Charlotte, New York, and Tampa. Now, Tampa was one of the places that went up the most, and it's keeping their gains. It's doing really, really well. All right, so why do some areas go up so much more and then not decline? And then some areas go up big and then also decline? Well, all economics, all prices are always broken down into supply and demand. I always keep coming back to it over and over and over. So it's supply and demand. We have to understand the supply and demand. So if everybody moves to Tampa, the prices go up. And if nobody moves away, the prices stay up. Right? You get it. So we need to take a look at this. Now, like I said, there's thousands of markets broken down by location, price, type. What do I talk about? So supply of new homes has been rising. The supply is increasing, but the demand's not there. All right? But existing homes, the supply is very tight. So there's a difference between brand new homes, tract homes being made built by builders, nationwide builders, versus existing homes. Now we can look at this in some of the data. Now what we can see here is that as soon as the pandemic started happening, we can see this is active listings, April, this is all pre-COVID. And so all of a sudden, all these homes went on the market. This was a hot area. All these people were selling their homes to move down to here, right? We have lots of activity going on here. Now compare that to now post-COVID, and what we can see is that the activity has slowed way down. This is the change in active listings. And so this has slowed way down. Supply and demand. There was lots of homes on the market, and now there's not very many homes on the market, so that's affecting it. Now we also have to understand there's a difference, like I said, between new and existing homes. Now we can see this. Here's a chart from Fred. The Federal Reserve gives us this data. This is month's supply of new houses. And so we measure the amount of homes for sale in the market by how many months it would take to go through based off of normal turn times. And so what we can see, I drew this red line here just so we can kind of get it like a trend line, like an average. And now this goes all the way back to 1965. And what we can see is that here's about 6.5 months right here, 6.5 months of supply. Now what we can see here is in 2008, during the great financial crash, the amount of homes, the monthly supply of homes went through the roof, of course, as it does in pretty much everyone. These gray lines are the recessions. So in these recessions, you can see the supply of homes go up because no one's buying homes. It went up big here in 2008. It pumped up a little bit during the pandemic, and then it came back down because all the stimulus, everyone's buying the homes. There was no homes for sale anywhere, but now we can see how high they went up, and they're starting to come back down a little bit. Now, they're not at record levels. It's not a record level, but it's certainly much higher than the trend line. So it's not super alarming, but it's something to watch. Now this is for new homes. Now let's take a look at existing homes. All right. If we take a look at existing homes, this is a 10-year chart. This goes back to 2014. We can see that this supply has been coming down. Now, why is that important? You have to understand that if I'm a nationwide builder, I'm a publicly traded company, I've built giant tracts of homes, I'm ready to wheel and deal. Man, I got these things sitting on my books. We have these profit margins. Let's just clear these things out. It's the end of the year. I don't care if I even take a little bit of a loss. Let's just clear out this inventory. So they're really ready to mark those homes down. However, if I'm just like a regular homeowner, we're in a neighborhood that doesn't have any new homes, if I don't want to sell my home, I'm locked in at a 3% mortgage rate, 30-year fixed. If I sell, I have to get a higher mortgage. There's no other homes that I want. I'm just not going to sell. I'm not motivated the same as a brand new tract home would be. And so I don't have the money. I don't have the room to wheel and deal. And so you can understand why existing home prices are going to affect much different. The other thing is, like I said, back to that mortgage rate. So we just saw some of the lowest mortgage rates all of history. People were locking in sub 3% mortgage rates for 30 years. I got one at about 3.5% for 30 years. Now, lots of people have those. As a matter of fact, what we can see here is this is the percent of adjustable loans. So as you might imagine, before 2008, 2005, 6, 7, the adjustable loans were the highest they've ever been, which of course led to this giant crash here in 2008. But what we can see is that we got this bottom here at the bottom in 2008. No mortgage lender wanted to give out these adjustable rate loans anymore. They were very gun shy about giving new loans. And what we can see is this low rate of adjustable loans has continued, which means almost nobody has these adjustable rate loans anymore. Almost everybody has 30-year fixed, locked in at 3%, 4% interest. Who is going to sell a home with a 3% 30-year fixed to go buy a new home at 7%? Pretty much nobody. And so you have to understand these market dynamics. So what am I saying? So in areas like where I personally live, there's no new tract homes. There can't be. There's no room. We're surrounded by the mountains and the ocean. There's no new tract homes. And so all we have is existing homes. So my area is going to be much different than if I lived like in a suburb of Las Vegas or Phoenix where it's tract homes everywhere. Right? So you have to understand supply and demand metrics. That's why this is important. It also depends on what type of house you have. If you have like a brand new tract home or you want to buy or sell a brand new tract home, it's going to be a lot different than if you're in an area with only existing homes. All right, now, why is this happening? And then if we can understand why it's happening, we can understand what should happen next. All right, so of course, it's all about the Fed liquidity. I always love to show this picture of Jerome Powell with the money printer cannon just putting out the money. But what we can see is that we saw a 42.5% increase in the money supply. All right, so they increased the money supply. Of course, I've talked about this a lot. So you can see since the pandemic broke out, this is how much they increased the money supply. Right here, 42%. And when they increased the money supply by 42%, what do you think happened to the home prices? Well, here's the Case-Shiller home index, and it also went up by 40%. Amazing, isn't that? You increase the money supply by 40%, home prices go up by 40%. This is why, this is a visual representation to show you why every time they print more dollars, your existing dollars buy less. It's not that home values went up, it's that the purchasing power of the dollar went down, and they went down at almost the exact same level. Now, it's not always the exact same level. Some homes in, I don't know, Kansas or Missouri maybe went up 10%, where some homes in Austin went up 150%. So scarce assets go up differently. However, we saw a 40% increase in money, a 40% increase in home prices. However, now that's changed. The Fed is starting to suck liquidity out of the market, and they're beginning to raise rates. Why are rates important? Well, it should be obvious. When rates are low, people want to take on debt. When rates go high, people don't want to take on debt anymore, and that's exactly what's happening. It leads to rapid home price deflation because if rates are high, nobody wants to take on new debt, nobody wants to buy new homes. They become too expensive. Now this shows the money supply, M2 money supply, and this shows the annualized growth rate of it. So the other one was like the total gross amount and just moved down a little bit. But this shows the percentage of change, the growth rate. Here's 2008. So in 2008, they increased the money supply pretty rapidly, of course, right, to bail out the entire global financial system. And then it came back down and it kind of evened out. Here we have the 2020 pandemic. And now look at it crashing back down. Again, I like to show you this chart because look at not only the size of the move compared to 2008, but look at the speed of the move. All right, so now that we understand the market dynamics, what's making the housing prices go boom and bust, where do we go from here? All right, that's the key question. What happens in 2023? Well, there's three things that we need to be paying attention to. One, the monetary growth, the liquidity, the supply of money in the system. Number two, what are the mortgage rates? What are the spreads on mortgage? What's the risk there? And then number three, I had to kind of make a correction here, it's the supply of the housing, right? Supply and demand. So the supply is the amount of units, the demand is how much money is available. So those are the two factors we want to look at and what is going to happen there. Now, when it comes to mortgage rates, a lot of people want to know what's going to happen. Well, you have to understand is that the government doesn't really set the price of mortgages. They set the Fed funds rate, and then the mortgage rate varies off of that. There's a spread. Now, what typically happens is we can look at it as a spread, a divergence off of the 10-year Treasury. What we can see is that gray areas are always recessions. In times of recession, when things are more risky, the spread goes up, right? And when things are good, the spread goes down. So right here, we're at a spread of 2.9, about 3%. So mortgage rates are about 3% over the 10-year Treasury. Now, if the market gets good, we can get back down into this range where they're about 1.5% over the 10-year. So between 1.5 to 3% over the 10-year Treasury. So then the next question would be, well, where is the 10-year Treasury going to be? Is the Fed going to continue raising rates? Or are they going to lower them? And of course, that's anybody's guess. Now, of course, Jerome Powell and friends are telling us what's coming next. It looks like they're going to find some rate around 5.5%. And depending on where the risk is in the system, that spread could change. So maybe we end up somewhere in the 6.5–7% range. For now, probably in through middle of next year is my guess. At that point, I believe the Fed is going to have to start bringing rates back down. I believe that the Fed has been trying to raise rates higher and faster, causing pain, so they have room to bring them back down. So they'll end up at 5–5.5%, and then maybe the Fed brings rates back down to 2.5–3%. Add in that risk adjustment spread, mortgage rates come back down maybe in the 5%–5.5% range. So if the mortgage rates go higher through next year, and then by the end of next year, let's say they start coming back down to 5.5%, that's what I'm guessing. Now, what about the home sales? Well, I'm guessing that the new home builders aren't going to be rapidly expanding the amount of new supply, so the supply on new homes will be constricted. I believe the supply on existing home sales will also stay constricted, because who's going to sell a home with a 3% mortgage to buy a 7% mortgage? So those are some of the factors, but we want to look at, like I said, the difference of new versus existing homes. So if you want to sell a home or buy a home, what am I buying? Am I buying it in Seattle and San Francisco that's already crashing, or am I buying it in Miami or Tampa that are not crashing at all? How do I know if my area is going to crash or go down? Well, supply and demand. Are people moving to that area? Or are they moving away? People are leaving cities with high taxes. People are going to rural areas with low taxes. They're warm climates. A lot of baby boomers are retiring. They don't want to live in the snow anymore. They want to go live in the Sunshine State. And they're moving to pro-business states. They don't want to be in states like California and New York that shut their businesses down. They'd rather be in states like Texas and Florida that are pro-business. And so again, if I'm buying and selling a home, what should I do? What do I expect? You have to ask yourself these questions for your particular area. Will there be more demand for houses? Are more people moving there? Or less demand? Are people moving away? Is it a new home or is it an existing home? What's the supply and demand? What's the demographic shift that's going on? I know you'd love to have an exact answer, but I don't even know how many cities and counties there are in the United States. There's a lot, and I can't tell you every single one of them, so you have to ask yourself these questions. Now, if you'd like my whole chart pack, all these charts, you can go through and find your city on there. I put a link down below. You can go download it, and that's what I got. Let me know what you think. Do you think that your city, the home prices will hold somewhat steady, or are they going to crash as bad as San Francisco and Seattle? Let me know in the comments down below. Of course, as always, give me a thumbs up on this video if you like it. If you don't, it's okay. You can give me a thumbs down, but at least tell me why in the comments down below. Hit that subscribe button before you leave, and that's what I got. To your success. I'm out.